Hello, and a very warm welcome to all joining us today. My name's Sebastian Steyne, and I'm a Senior Wealth Manager here at Nutmeg, and we're here to discuss our newly launched income portfolios. We're really excited about this new strategy, and we believe it's going to help us meet even more of our clients' needs. I'm joined today by my colleague and Wealth Manager, Stephen Craig. We also have Nutmeg's Head of Portfolio Management, Pacome Breton, with us, as well as Mark Jackson from JP Morgan Asset Management. They're on hand to answer any questions that you may have that relate to the nuts and bolts of how everything works. So without further ado, I'm going to hand over to Stephen to outline what you can expect us to cover today.
Thanks, Seb. So first we'll explain why we introduced this solution for our clients. We'll then discuss some scenarios where income investing may be beneficial. And finally, we'll discuss how the strategy works, including a word from Mark. There'll also be plenty of time at the end to discuss any questions from those watching live or that we've collected ahead of time. If you send a question and we don't manage to get to it, please do feel free to scan the QR code, which will display throughout the webinar. And this will allow you to book a call with our expert team. Our wealth services team will be here to answer any questions and discuss your personal situation for free at a time that suits you. I'll now hand back to Sebastian, who'll discuss why we launched the strategy.
Thanks, Stephen. So in launching income investing alongside our growth styles, we wanted to stay true to the principles that have been at the heart of the company since our beginning. Nutmeg started its life as a disruptor in the wealth management space, and the business is built on a core purpose, the idea that everyone should be able to tap into the power of investment. We wanted to offer a transparent, high-quality wealth management user experience with an intuitive user interface. Our ongoing evolution means changing to meet more of our clients' needs, and our new investment style is designed to pay a regular, consistent income stream to investors. While we have always had portfolios which are focused on delivering growth over the long term, the income portfolios aim to invest into more companies and bonds which pay out higher dividends or fixed income, and use a strategy which we'll touch on later, which aims to enhance the income which investors can receive. Essentially, the income investing strategy is an extension of our founding values and designed to help more of our clients meet more of their financial goals. The new investment style joins our existing range of growth-orientated investment styles. And for a large number of our existing clients, the focus on growth will likely remain the most appropriate option. Our growth styles will continue to operate as usual, with the same focus on creating globally diversified, balanced portfolios, managed by a team of experienced investment professionals, and with the same level of ongoing support our clients are accustomed to from our expert team. So to emphasize the point, you will still have an experienced investment team applying the same disciplined investment process to the management of client funds. As with the growth-orientated focused strategies, the income portfolios will be constructed using exchange-traded funds or ETFs, which are low-cost, efficient, transparent, highly liquid, and diversified investment vehicles. So who is income investing right for? Well, some investors may not be aware to the extent to which their investments can be tailored to specific circumstances. Everyone's financial goals are slightly different, and the route to which you take to reach those goals may indeed vary compared to someone else's. So if you are in the early years of your career and are investing for a long-term goal, focusing on growing your investments is likely to be your top priority. As highlighted, most of our strategies prioritize capital growth. You might, on the other hand, be further into your investment journey, closing in on retirement and/or reevaluating what you want your investments to achieve for you. So whether it's providing growth, your investment portfolio can be a powerful tool to produce a consistent stream of income. This could help to support you at different stages in your life for a wide range of personal circumstances. Financial goals and priorities can change, and it's important that the way your portfolio is invested is aligned with what you're trying to achieve. So Stephen, if you could kindly just go through some examples of life events where income from investments may indeed be sought.
Sure, thanks, Seb. So which situations might income investing help with? Well, generating an income from your investments might help you deal with specific life events or expenses. For example, funding your children through university can see monthly outgoings increase. Income from an investment portfolio could help meet the added expense. You might also be approaching retirement and want some of your investments to focus on providing an income to cover expenses. Moving from a higher salary to a lower one can be daunting, but adjusting your investments with the aim of paying an income more regularly could help smooth the transition. Or maybe you've received a lump sum and you'd like to make the most of it from an income perspective. There are also those who might be looking to supplement a more variable monthly income. For example, you might be self-employed and have a more unpredictable income, and that can make planning your finances more challenging. Investing for income could help you make your pay more consistent, especially with our income smoothing feature, which is designed to provide a similar payout each month. Finally, some investors might simply just want added flexibility. You might be looking to work fewer hours, and as a result, maybe considering how to supplement the reduction in earnings using your investments. So having some of your portfolio focused on generating an income alongside your longer-term growth portfolio might offer you the flexibility that you need. It's worth mentioning at this point that you cannot yet use the income investing style in a personal pension, and it won't be available in the junior ISA or lifetime ISA accounts due to suitability. If you want to discuss your own personal circumstances, however, do scan that QR code and you can book a call with us. So what do we mean when we say income investing, and where does the income come from, so to speak? Investors can receive income from their portfolio in different ways. Two of the most common methods are by investing in the equity of companies that pay dividends and buying bonds that pay a regular fixed income. Equity income is usually in the form of dividends, which are payments made to the shareholders of a company. Not all companies pay dividends, and companies that are solely focused on growth will typically prioritize reinvesting cash flow back into the business. However, some will pay a dividend to attract and keep investors, to indicate financial health, and to return profits to shareholders. Some well-known examples of traditionally dividend-paying companies you may be familiar with include GlaxoSmithKline or Unilever, amongst others. Any company paying a dividend can change its dividend-paying strategies, so you should always do your own research before choosing the companies that you invest in. Fixed income investments, a typical way to refer to bonds, on the other hand, are expected to provide regular set payments over a specified period. They represent a loan made by an investor to a borrower, such as a government or a company. Bond terms would typically agree that the investor receives payment or the fixed income in return for providing the loan, with the initial investment amount returned at the maturity of the bond. We typically hold government and corporate bonds within our portfolios. Multi-asset portfolios, like the ones that we hold at Nutmeg, combine bonds and equities. And how much income the portfolio generates will depend on, number one, the weighting of the allocation to each in the portfolio, and number two, the nature of the investment selected. For example, some equities are income focused while others aren't. The price of bonds and equities tend to move in opposite directions, something called inverse correlation, and this can offer diversification for investors, which is one of the fundamentals of risk management. So now that we've discussed some traditional approaches to income investing, what's our approach? At Nutmeg, we adopt a multi-asset approach, working with our partners, JP Morgan Asset Management, one of the world's leading investment houses, in building the strategy. We combine our core investment principles of diversification, transparency, and expert risk management with JP Morgan's vast experience, resources, and multi-asset knowledge. Our investment team will be responsible for the overall management of portfolios, and this involves setting the asset allocation of the portfolios and actively adapting it over time. We'll make tactical adjustments informed by the research of JP Morgan Asset Management so that we can take advantage of emerging opportunities. The role JP Morgan Asset Management plays is one of advisor, helping to design the structure of the portfolios and providing our investment team with ongoing investment strategy advice. This includes advice on rebalancing, asset allocation, and fund selection. The result will be an investment style which invests in traditional equity, income, and bond ETFs, while also investing in specific income-focused ETFs developed by JP Morgan Asset Management. For this next part, we'll hand over to Mark on the JP Morgan Asset Management team to explain more about how the JP Morgan income-focused ETFs work and what makes them so innovative. Now, this next section will be a little bit more technical, so don't forget, if you do have any questions, you can scan the QR code and book a call with our team.
Thanks, Stephen. Yes, so an important part of the income strategy is the use of JP Morgan's innovative income-focused ETFs. These ETFs use an approach to income production that differs from the more traditional income portfolios mentioned earlier. As we touched on, income portfolios will often have significant allocations to high dividend stocks, aiming to generate income through dividends, and/or bonds, which aim to generate income through coupon payments. The Nutmeg income portfolios do have some allocation to bonds, which we believe can continue to generate income for investors over time. However, the ETFs in focus today, JP Morgan Global Equity Premium Income and NASDAQ equity premium income, use an innovative approach to generating income from equity exposure. Instead of investing in high dividend producing stocks, the use of options, specifically call options, helps to transform some of the potential increase in equity value or the upside of the underlying stocks into income generation today. So in a sense, these ETFs aim to swap some of the upside return from growth in stock price into income available today for investors. So we've designed these ETFs to achieve 4 expected outcomes. The income, enhanced by the use of options, is produced on a monthly basis to help smooth returns. These ETFs have a track record of lower volatility than the MSCI World and NASDAQ 100, the equity indices that they're built to track, enabling us to retain risk-managed equity exposure. And this aims to translate into improved risk-return ratios, and ultimately, it's designed to deliver an attractive total return to investors.
Thanks, Mark. Now, you've heard of Mark mentioning the use of options there. So we're going to explain a little bit more about what they are and why they're used now. An options overlay is a type of investment strategy that uses what are called derivatives. And these are financial instruments that can take many forms, and they're often used to manage risk. The addition of some ETFs that use an options overlay as part of our portfolio construction allows us to target a more significant level of income. The addition of the overlay means the strategy has the potential to perform better in periods of flat or falling equity market return, but will give up some potential capital upside during strongly positive equity market performance. We believe that a fundamentally strong portfolio coupled with this disciplined options overlay could enhance the income investors receive, while also helping us to manage risk. We should note, however, that as with all investing returns, whether through capital growth or income payouts, as prioritized with our income investing style, are not guaranteed. Seb's now going to explain what you can expect if you choose income investing at Nutmeg.
Thanks, Stephen. Well, yes, as we mentioned earlier, our income product was launched to help us meet real client goals. We speak to our clients regularly, and we wanted to incorporate some of the feedback that we've received. That's why many of the income investing features are above all client-driven. The income target you can see here of between 4 and 5% per year is illustrative of an income level that we think is realistic, will not expose our clients to undue levels of risk, and what we believe is sustainable. It's been designed to pay income at more regular intervals and should help keep payments as consistent as possible, depending, of course, on market conditions. We wanted the product to be as easy to use and to require as little additional administration as possible. This is why we have the innovative income smoothing feature to address one of the main pain points investors can face when drawing in income from investments. It has been designed to pay income on more regular intervals that can be expected from ETFs normally and should help keep payments as consistent as possible, depending on market conditions. To do this, we set aside some of your portfolio earnings and to manage the timing and spread of your payouts. We aim to make the value of payments as consistent as possible. However, we won't be able to guarantee completely equal payments from month to month, as many parameters can affect the value of ETF dividends. It should also be noted there is a period of time between the initial investment and the first income payment. This is to allow the portfolio time to generate the first income payouts. To allow clients to invest for income in a way they are comfortable with, we have 5 different risk levels, spanning from lower to high risk. The investments held in the different portfolios reflect the range of risk and return goals. Given we'll be aiming for an enhanced level of income, by nature, the growth potential will be lower than for our other investment styles. For this reason, income portfolios may not be appropriate for investors prioritizing growth. However, the portfolio design also means we expect it to demonstrate lower volatility than our managed portfolios of equivalent risk. We expect the income portfolios to perform better in flat or falling markets, albeit with the potential to underperform in strongly rising equity markets. And just to touch on the tax implications briefly, as there may be some considerations for investors. For some, the income their investments generate may be all or a large portion of their total income in any given tax year. For others, income from an investment portfolio might be in addition to income received by other means, like employment. Whatever the circumstance, investors should understand the tax implications of investing for income compared with investing for growth. It's always worth seeking professional advice if you're unsure about where you stand. And please note, Nutmeg does not provide tax advice. What type of account the income is being generated is also important. Income generated by an investment outside of a tax-wrapped account, such as a pension or an ISA, including junior ISAs and lifetime ISAs, in most cases will factor into an income tax calculation for the given year. In most cases, investments that sit within one of these types of tax-wrapped accounts are protected from income tax and capital gains tax. Income tax taken out of an ISA will in most cases not attract income tax, while on the other hand, income taken out of a pension will in most cases. There's a difference between capital gains and income tax. Most portfolios will generate a combination of capital gains and income. Capital gains will not factor into a tax calculation unless they are realized, meaning an asset that has increased in value has been sold. This includes, of course, when Nutmeg sells assets to change the asset allocation of your portfolio. Gains realized in an ISA or a personal pension typically will not attract CGT, whereas gains realized in a general investment account may attract CGT if they exceed an individual's annual exemption amount. There's lots more information about CGT on our website. Tax rules, of course, vary by individual status, and they can, of course, also change.
Thanks, Seb. So in terms of what it will all look like, we wanted to include a couple of examples of what it might look like for the investor. You can still access all of your account information as easily as you can with your other Nutmeg accounts. And here are a few examples of the screens you might see when using the income investing strategy. And this will include as well an illustration, as you can see on the right-hand side, of the income smoothing feature. Now, as promised, we set aside some time to answer any questions you might have. And between myself, Sebastian, Pacome, and Mark, I'm sure we can cover anything that you'd like to. But if you do have any more specific questions or want to discuss your strategy in more depth, as we say, please do book a call with our expert team and we'd be happy to help. Seb's now going to read over any questions we have and we'll decide who's better placed to answer these.
Thanks, Stephen. I am indeed. So the first question we have here is a good one. How much growth am I sacrificing for the sake of income? Pacome, would you kindly answer this one, please?
Yeah, certainly. The income investing style actually is not expected to provide a significant level of performance divergence in terms of total return, which is capital growth plus income versus our range of other investment styles. So the source of performance is expected to be different though. The primary goal for income investing is to provide a healthy level of income for investors combined with long-term capital growth. So with the goal of an enhanced level of income, it does mean that by design, growth potential is lower than our other range of investment styles. And income portfolios may not be appropriate for investors who are prioritizing growth.
And I can jump in here as well, if helpful. As we discussed earlier, some of the ETFs we have exposure to use an options overlay strategy with the aim of providing increased and more consistent income stream. So this involves selling options to collect premiums, generating income, but sacrificing some of that potential market gain. But importantly, this part of the strategy is implemented on a weekly basis to control the extent to which the portfolio might feel the effects of missing out on market gains.
Thanks both. So this next question is one that we were anticipating. Why can't the income strategy be used in a pension? I can answer this one myself. So it's a very fair question, and without going into too much detail, it boils down to the technical limitations of the provider that we use to administer our pension accounts for now, which is currently unable to accommodate the way our income portfolios needs to be set up. Now, it is also a matter of public record that Nutmeg is looking at ways of introducing new pension technology, and we are, of course, very keen to offer income portfolios via our personal pension offering, but it will take some time for us to be able to do that. So the next question that we have is that on income flow. Will my income remain consistent? Pacome, may I hand over this for you to answer, please?
Yes, sure. That's a great question. So the level of income will vary with the value of the portfolio. We actually have a couple of charts here that you might see online, because we got this question ahead of time. So the charts compare income levels for two comparable risk levels of both the income strategy and our smart alpha strategy. And you can see a few things there. One is that the annual yield can be expected to move around. And another is that the income produced by the income strategy is expected to be consistently higher than the equivalent risk levels of our other strategies. And one thing you can see is that the difference in income is expected to be more pronounced between the higher risk levels of different strategies because of the way expected asset allocation influences the nature of returns. So if you choose to use the smoothing feature of the strategy, which is another differentiating characteristic of our income strategy, you can expect more regular monthly cash flows of a similar value. And to do this, we set aside some of your earnings to manage the timing and spread of your payouts. We aim to make the value of payments as consistent as possible. However, we won't be able to guarantee completely equal payments from month to month, as many parameters can affect the value of ETF dividends. And it should be noted that there is a period of time between initial investment and the first income payment. And this is to allow the portfolio time to generate the first income payouts. Factors as well influencing monthly yield include interest rates and credit risk, and particularly for the fixed income element of the strategy. Global economic strengths and the broad market environment will be a factor as well. And the yield provided by the option overlay feature used in some of the JP Morgan Asset Management Income ETFs, they will also vary depending on market conditions and level of market volatility.
Thanks very much indeed, Pacome. Now, sticking with you for a moment, we have one here about the management of the income portfolios. How often are they rebalanced?
So those portfolios are discretionary managed. So the rebalancing can be done depending on the investment in view of the market opportunities and the need to change them. However, having said that, we still expect those to have a relatively limited number of rebalancing, just because they tend to be slightly lower volatilities and other growth portfolios than we have, and slightly longer term focus. So you could expect to be, on average, relatively quarterly rebalancing, maybe slightly less depending on market. And of course, if there is relatively important market events or changes, it can be more frequent depending on those market conditions.
Thanks, Pacome. So we've also been asked to, when income payments are made, if there's any flexibility on when they can be paid out. Stephen, can I leave this with you to answer, please?
Yeah, definitely. Thanks, Seb. So the scheduled payday for the strategy is set for the 24th of each month. Again, it should be noted that there is a period of time between the initial investment and the first income payout. And this is just to allow the portfolio time to generate the first income payouts. Now, there may be exceptional circumstances in which the payment can be processed manually before this date, but I want to be clear that the usual payment date will be for the 24th of each month.
And Stephen, while I have you on the subject, another question is, will the fees be any different than our existing growth strategies?
Yeah, that's an important point. So the management fee, which is the Nutmeg charge for managing your portfolio, will be the same as for our other managed growth portfolios. However, other fund costs may be higher. And the reason for that is, firstly, there's a small added cost with the option overlay strategy. And secondly, some of the funds are actively managed, which can be a bit more expensive. Although, given how these ETFs align to the portfolio's aim of generating a higher income and lower volatility, we feel that this additional cost is worthwhile. And I'd also like to highlight that should you open an income portfolio with us, management fees will be waived for the remainder of 2025.
Thanks for that. So now let's look for some additional questions which have come through during the presentation. And what I'll do is just pull a few out, which I think will be most pertinent. So I've got one here. What is the typical share between corporate and government bonds held by Nutmeg I presume in relation to these income portfolios. Pacome, Mark, perhaps if you could add your comments here.
I can take this one. So basically, the portfolios, the size of the fixed income will depend usually on the risk level. So lower risk level will have higher amount of invested in fixed income, and higher risk level. So risk level 3, 4, or 5 out of 5 will have more invested into equities and less in fixed income. So within this fixed income bucket, which varies by risk profile, it's going to be different between corporate and between government bonds. The income portfolio tends to have higher allocation to corporate and higher allocation to high yield, due to the need to generate higher income. High yield fixed income tend to be more to generate more incomes than typical government bonds. So we have a higher proportion of corporate bonds, and within corporate bonds, a higher proportion of high yield than what you can see in fully managed or smart alpha portfolios.
Thank you, Pacome. And we've got a question here. It says, I already have a stocks and shares ISA with Nutmeg. Can I add a passive income portfolio to this existing ISA? And I can answer this one. And the answer to the question is yes, you certainly can. So within our ISAs, you can set up multiple pots. So you can have a portion of your ISA allocated to a growth-orientated portfolio. And indeed, you can have another portion weighted towards our income portfolio, and you can chop and change at your discretion. So, in that sense, a lot of flexibility there, which, really does allow for our clients to target specific investment objectives. And our ISA, of course, is one way of achieving that, as well as, I should add, you can do so through the general investment account too. So that answers another question here, which we've got about whether or not the product can be used outside of an ISA. Now, is the income strategy what is the income strategy's lifetime? Or do you expect circa 20 years? Stephen, would you mind perhaps answering that one, please?
Yeah, so I think it depends on the investment strategy that the investor is looking to take. You can certainly hold it over the long term. As we mentioned earlier, when it comes to growth portfolios, certain people might be more suited to, they might be in a particular stage of their investment career and they think that growing their portfolio is still more appropriate to them. But, as people get to different stages in their life whereby income investing can be more appropriate, you can hold that over the long term and it can be a longer term product, or equally, you can switch from one style to another as your life changes and as you approach different experiences. I don't know if you wanted to add anything to that, Sebastian, or?
Yeah, I think, it's just worth reiterating the point that this still is a long-term investment product, and we would suggest minimum timeframes of 3 years. But certainly if one is able to withstand market conditions for that sort of period of time, there may indeed be, eligibility around you investing in an income portfolio. I think, whether or not one steers towards an income portfolio, a more growth-orientated strategy is really down, as you say, Stephen, down to your objective. Clearly, there are going to be certain longer-term investment objectives that are more conducive to a growth-orientated approach, and there are going to be other, perhaps more short-term needs, 3, 5, however many years ahead, whereby supplementary income might be required, and that's where perhaps this income strategy comes in. So another question we've got here is, can you clarify what you're giving up on the 5 risk profiles, growth and income? So, I could answer that question. And effectively, the way the income portfolios operate is as you go up that risk curve, you're offsetting some potential level of income for that of capital growth. The reverse is true as you go towards the lower level of risk levels within the income portfolio, where income can be expected to be higher, but the potential for capital upside is reduced. Is it possible, perhaps, Mark, Pacome, you could sort of chip in here and maybe elaborate around that in terms of the risk levels of the actual income portfolio?
Yes, sure, Seb, I can. And I think there are 2 points in the questions, really. One is basically on, how much potential growth you're forfeiting, and as well the potential level of risk you're taking in the different risk profile. So in terms of the potential long-term growth you're forfeiting, yes, there are clearly the portfolios are going to be slightly lower volatilities than what you see with our other smart alpha fixed allocation or fully managed, and which means potentially you're going to have maybe slightly lower short-term return, but we still balance the overall of those portfolios and calibrated in a way where we think that basically over the long run, over different market scenario and periods, the difference in performance might not be that significant, assuming someone would have reinvested the income, of course, for a fair comparison. After the level of risk between the different risk levels is relatively similar to what we have with our smart alpha rounds. We have 5 different profile. Lower risk would be much more invested into fixed income, closer to around 80% in fixed income and 20% in equity. And the risk level 5 out of 5 will be mostly an equity portfolio, slightly lower vols than a comparable one from a smart alpha or fully managed, but still fully invested into equity. So that's basically the two aspects. Long-term growth, some differences, but over the long term, we still expect them to perform relatively similarly. And in terms of difference in volatility among the different risk levels from 1 to 5, there will be a divergence because, of course, it depends on people's need and suitability for the risks that they would choose and they would be guided to.
Absolutely. Thank you, Pacome. And what is the time lag? Another question here. What is the time lag between investing for income and receiving the income? Now, I appreciate if the smoothing function is switched on, it's typically between 3 and 4 months even for that income to come through. Is there any more detail perhaps we can add there in terms of the time lag between investing for income and the actual income being received?
Yeah, I can take this one as well. No, there are different aspects in it. The first one is when you're going to start the first investment and the first time you're going to receive some income. ETFs tend to declare even an ETF that pays monthly dividend will tend to declare the dividend on basically the early part of the month, and will pay it 1 month after. So when you start, depends when you start your first investment. In any case, if you start towards mid-month or end of month, you're going to delay it, and it can be up to 1.5 months or 2 months before you start to receive your first income from an ETF you invest with. Just because there is this time lag between the time an ETF declare and register a dividend and the time it pays it. And after the income smoothing will be will take some time. It's not really to receive the first payment, but it's to receive the first tables payment. So it can take between 3 and 6 months, assuming you don't change your allocation to the pot, that to get a more smoothed payments. So assume after 6 months you would receive more or less a relatively smooth payments, and it will take 3 to 6 months to get there. And as well, from the first day you invest, it can take up to 1.5 months to 2 months to get the first dividend payment.
Thanks, Pacome. And another question on a similar subject. So are the payments dividends or interest or a mixture?
It's a good question. So they're going to be dividend by the nature of it, because those invest in ETFs, not directly into single equity or into single fixed income. There will be some interest as well because of the small cash component, but they will be all considered as dividend. And for tax purpose, though, I encourage to, we're not, as you said earlier, we're not tax advisors, so I encourage people to get their own tax advices. Where we make some hint and some, we give some information in the white paper and on the website, but we're not tax advisor, and so we advise people to take their own tax advice on the different products they invest with.
Absolutely. Thanks, Pacome. A question here. So can I drip feed in larger investment lump sums over 6 months? And I can answer this one, and effectively yes is the answer to that question. So we've got a cash pot function effectively that sits within either a general investment account or an ISA, and you can drip feed funds at your discretion into the market. It allows, of course, one to employ what's known as pound cost averaging in an effort to try and avoid mistiming the market. So that's certainly something, you know, that is available on the dashboard. Lots of questions here around whether or not recordings will be sent out, and I can, you know, confirm that there will be a YouTube which will be available for everyone to either rerun this. I appreciate there's a lot of information here, or indeed anyone that couldn't make the call today, but that is all we have time for today. I want to thank everyone for joining us, and we hope, of course, that you found it useful. Thanks also to all our panelists, Pacome, Mark, Stephen, and once again, if you do have any questions for the team, please do scan the QR code. I appreciate, you know, there's a lot of information here, so use the QR code to get in touch, and we can get you connected with one of the team who would, of course, be very happy to field any of the questions that you may have around our income portfolios, or indeed anything else for that matter. The webinar, as I said, will also be available on YouTube. So if there is anything you've missed the first time around, you can check that out at your leisure. Otherwise, thanks so much for joining today, and goodbye.